Right now, somewhere inside your banking app, there is a number quietly insulting you. If you keep your money at one of the largest brick-and-mortar banks in America, that number is 1/100%. Leave $100 there for 12 full months, and your reward is one single penny. This diagram illustrates exactly what that looks like in reality. Take a loyal saver named Yvette. She's parked $31,000 at her big bank for years. The tiny positive sliver you see here is her $3 annual interest. This massive negative bar represents the roughly $1,000 of purchasing power her money loses to inflation over that exact same year. Compare that to her brother-in-law, Curtis. He has the exact same balance, covered by the exact same zero-risk federal insurance, but he earns about $1,350. That is 450 times more yield. Curtis captured this massive yield with a single 15-minute form filled out while half watching television, an administrative win that remains open to Yvette the moment she decides to take it. Yvette is far from alone. Collectively, Americans hold roughly $10.2 trillion in checkable deposits and savings accounts. A massive chunk of that cash sits earning nearly zero. The average American has banked with the same institution for 17 years. Your direct deposit is routed there, your bills are on auto pay, and the numbers on your debit card are worn completely smooth. The entire banking relationship is designed around the assumption that you will never overcome that friction. The system relies entirely on your complacency. To understand who keeps the money you're giving up, we have to look at a metric called deposit beta. Deposit beta measures exactly how much of a Federal Reserve interest rate change your bank actually passes on to you. Watch deposit beta in action. When the Fed cuts rates, banks immediately cut yours. But during a hiking cycle, the Fed raises rates, yet the customer savings line stays flat. That shaded gap between the lines is pure bank profit. You absorb the losses immediately, but you wait indefinitely for the gains. Deposit pricing is incredibly flexible on the way down, but suspiciously sticky on the way up. Between 2022 and 2023, the Federal Reserve ran the fastest rate hiking cycle since the 1980s. Over those 16 months, the big banks politely declined to pass those yields along. They knew your inertia would let them legally pocket the difference. When people finally wake up to this gap, they often make a critical mistake. They search for the absolute highest number they can find, usually landing on a flashy, heavily marketed tech app. These apps usually feature a comforting line of text reading FDIC insured. But apps are not banks, they are middleware. They partner with chartered banks and pool your money into shared accounts. In a setup like this, the federal insurance only passes through to you if a third-party tech company maintains a perfectly accurate ledger tracking exactly whose money belongs to whom. In 2024, a middleware company called Synapse, which sat between dozens of apps and their partner banks, went bankrupt. The ledgers hadn't been properly reconciled. Over 100,000 people were locked out of their own legally held money. Curtis nearly fell into this exact trap. He moved $30,000 into one of these apps for an extra 15 basis points of yield, risking his entire principal balance for an extra $45 a year. Federal insurance covers the failure of the bank itself, while offering zero protection against a tech company losing track of your name on a ledger. Over any 20-year timeline, cash has been a terrible place to build wealth. U.S. stocks have historically crushed cash savings over the long term, but right now we are sitting in a strange anomaly. A high-yield cash account currently pays around 4%, while 10-year forecasts for U.S. stocks sit at a relatively subdued 3.9 to 5.9% annualized. For the first time in 15 years, holding cash is highly defensible. Still, your cash allocation has a strict limit. It should only hold a 3 to 6 month emergency fund, along with short-term sinking funds for known upcoming expenses. Because when life happens, having that cash cushion stops a blown tire from becoming a credit card balance you carry for 2 years. A high-yield account functions as an automated guard for your liquidity, ensuring your safety net grows while you sleep, rather than evaporating into the background noise. Before you move your money, consider your zip code. If you are a high earner in a state with income tax, a lower-rate U.S. Treasury bill, which is exempt from state and local taxes, often leaves you with more actual take-home money than a high-yield savings account. Here is your strict action plan. Confirm the rate is permanent and not a temporary promotion. Ensure it covers your entire balance, not just the first slice. Verify you are depositing directly into an actual chartered bank, not a digital app. This chart shows the long-term impact of making this move. Leave $30,000 at the national banking average for 10 years, and it stays entirely stagnant. Move that same $30,000 to a competitive rate, and you generate an extra $15,000. No bank is ever going to send you a letter explicitly inviting you to leave. Overcoming your own inertia will be the single highest paying 15 minutes of your entire year.